Written by Dr. Yasam Ayavefe.
Funds in finance. The current crisis has brought some lesser-known players to the fore, as their strategies are complex and allow them to be little regulated or not very transparent: private equity funds, sovereign wealth funds, etc. Eliminating middlemen is the starting point for these new players. Banks have long ceased to be the exclusive conduit to finance the economy through debt. Eliminating middlemen has brought prominent players, individuals and companies in the economy back to the fore, while also revealing new players linked to funds that are significantly different from the traditional and complex securitization architecture. New generation mutual funds. New mutual funds are more complex and often riskier. These funds first appeared in the post-war period. Today, however, they are in a position to significantly change the face of world capitalism. Hedge funds. They are private mutual funds open only to knowledgeable investors, so they are little regulated. In particular, it does not have valuation or restrictive liquidity. Hedge funds use all options and structured products that allow to hedge against the whims of the market. It is quite different, with its strategies aiming to keep their performance free of stock market trends through complex investing and arbitrage strategies. Through arbitrage strategies, funds contribute to market efficiency. It must be admitted that there are assets of approximately $1,700 billion worldwide. Amounts managed are modest compared to assets managed by banks and traditional mutual funds. It represents less than 2% of the total assets of industrialized countries. However, all it takes to make markets efficient are assets that don't need to be risk-taking and substitutes when the markets seem out of order. Among the risks are the few players who are most likely to referee. The funds also contribute to the reduction of banking risks, thanks to the risk transfer tools they provide. However, hedge funds are still perceived as risky players. Require skills that are not guaranteed to be available, knowing that these skills are hard to find. These funds, which publish little financial information and are located more than 3/4 overseas, should not be transparent. Knowing that the losses may be unlimited, short selling should be practiced. Systematic use of significant leverage effects, which are financed by banks and thus make them vulnerable to changes in bank liquidity, is important. This perception has sharply increased with the closing of several funds with significantly high interest rate risk. However, it was not confirmed in later events. In fact, hedge fund sales are mortgage-backed securities, accounting for 5% of their market share. Notably, despite its significant exposure to $80 billion, the turbulence in recent months has not been a determining factor. Creating a source of systemic risk plays a more stabilizing role for hedge funds. Private equity fund. Private equity or investment capital consists of buying shares in the capital of small and medium-sized companies that are not listed on the stock exchange. This is different from those who invest in listed companies. Private equity is not speculative and does not play a transformative role. Its investments are long-term investments with a horizon of about 10 years. Private equity funds are funded by high-net-worth individuals or institutional investors, banks, insurance companies, and above all pension funds with debts or equity that allow them to make long-term investments. Private equity largely replaces bank loans to SMEs, which contracted sharply in the 1980s and 1990s. It plays an important, even irreplaceable role in the economy. It allows SMEs to access capital at a lower cost and benefit from the experience and professional network of fund partners. More fundamentally, it solves the classic problems of adverse selection and moral hazard arising from the information asymmetry between the investor and the company involved. It links these issues to company performance and provides greater monitoring of the company within the framework of the board of directors. It solves it through the practice of governance that gives better incentives to managers to align with the interests of shareholders. As venture capital, private equity plays a particularly important role in the creation of companies where, together with the managers and their relatives, it is virtually the sole financier. Thanks to its presence in these two segments, private equity is a key player in innovation and research and development. However, its core business, which is also the most profitable, is concentrated on transfer capital or leveraged buyout, which accompanies SMEs at various stages of their growth.
Written by Dr. Yasam Ayavefe.